Olá, sejam bem-vindos ao Fintech Talks Podcast. Meu nome é Bruno Diniz e hoje a gente tem um episódio especial, dessa vez recebendo um convidado internacional. Eu vou mudar agora aqui para o inglês, a gente vai ter legendas. So, we are here now with Paolo Sironi, my friend. He's an author, he's a speaker and also global research leader in banking at IBM. For banking and financial markets, right? So, Paolo, it's an honor to have you here. Last time we had the chance to meet again in person was in Febraban Tech 2024. Then you came again for the IFC Forum, and I wasn't able to meet you there because I was traveling. But here we are again, and I hope we have a very great episode discussing some of the topics that I know you excel on, which are contextual and conscious banking, economies and platform economies, and everything in the AI age. So we also have the AI component. We've been talking, discussing before being aired here. That's one of the challenges. Things are moving exponentially. Sometimes it was hard for us to tell the clients how is this exponential change, but I think most of them are living it now. So again, thank you so much for being here. At the podcast, Fintech Talks.
Bruno, obrigadissimo.
Oh, fantastic.
And being with you on the podcast is tutto gioia.
Amazing. So, Paolo, you're here in São Paulo for lots of meetings that you're here for the week. Also have the chance to attend to some other podcasts. But what brought you here to São Paulo this week? Basically, what is the main topic of this trip that you make here for the country?
Well, actually, so we have a new research brief that we launched in Brazil. It's the second time that I launched a research brief in Brazil, which is this one. Yes, it's a smaller printed version of banking in the AI era, the risk management of AI and with AI. Oh. That basically is a survey on 100 executives worldwide working at primary banks with responsibilities in risk management, validation, or compliance. So we try to understand, that risk perspective. And I had the chance of being invited by the risk management department of Nubank for a first worldwide premiere of the content of this research with them. And so it was my pleasure to be here in Sao Paulo for that opportunity. And then, of course, that gave me the chance of sharing more with the broader community of our clients as well as the audience of your podcast.
Amazing.
And I think this is special. Especially because I said last year I was here launching another paper, Banking for Small and Medium Enterprises. When I do research, I also talk to execs and clients worldwide, and a couple of them from Brazil shared their perspective that we published in a research compendium called Voice for Makers. So we had Maximiliano Damian, head of commercial business of Nubank, and Franco Fasoli, head of commercial banking of Santander Brazil. And but not just because I have these, if you like, strong connections with your business community, that this one in particular this year is special to me. It's special to me because in the 1990s, when I started my career, I was head of quantitative risk management for Italian banks in market and counterparty credit risk. Now it's called Intesa San Paolo. At the time was BCI, then became Intesa San Paolo. And BCI at the time owned Sudameris Bank here in Sao Paulo. Wow. And so I was the superintendente for risk management, I don't know if you say that, and for Sudameris from the group level. So I was coming to Brazil every quarter here to Sao Paulo, primarily in Paulista. And then is when I discovered the wonderful Ponge area to go to Rio de Janeiro on weekend. So now being back to Sao Paulo to launch a study about the risk management of AI is like reconnecting 20 plus years of professional experience that started back then. So it was kind of emotional to be here with your banking community as the primary spot to deep dive into why the risk management is the turnkey to allow AI to scale enterprise-wide.
Fantastic, and always new topics to talk to here. I think every time you come here to the country, there are lots of new topics on innovation, on financial innovation. But I would like to go back and discuss a little bit about your early days. You said that you were like working in the quant department, right? For that Sudameris.
Yeah, it was BCI, the
BCI.
Residenza San Paolo, that owned the Sudameris Bank that
Yes.
was sold in 2004. And so it was primarily the Basel I, Basel II models for market risk management, so the trading floor and counterparty credit risk. So how you deal with financial innovation and that stuff that preceded fintech innovation. Because until the global financial crisis, there was financial innovation.
Exactly.
And then became fintech innovation. So
yes, and tracing back to that time, after you worked at in this position, what came after until you got to the point where you are like an author, a best-selling author, and also
I've always been a substantiated yet crazy person, because in 2008 I left Intesa San Paolo and I moved to Germany, to Frankfurt, to build a fintech. You know, I don't know how many people can say they moved to Germany to build a fintech in Italy. And but that I had my partner. My point has always been you need the pipeline before you have the product.
Yeah.
I'm sorry to say that, but I think it's relevant. Otherwise, a lot of fintech don't have an idea of how to go to market, and that's how we did. And I built with two partners, Capitex, that was a digital wealth management solution. And IBM bought Capitex in 2013, so I had like 22 people on the payroll.
5 years after you guys launched it.
Yes. And by the way, maybe not for this podcast, but it's interesting the way I developed the go-to-market, okay? Because thought leadership has always been my primary focus. You need to tap into the real motivation of people because it's hard to see, to imagine, to understand the value of change. And so I always made sure that I was not going to conferences to show the product.
Yes.
I was meeting people to understand the principles, and that's allowed me to start, selling the solutions. And then when I joined IBM and I positioned the capabilities inside, I took the role of portfolio strategies for risk analytics. And then 5 years ago, I took this role that I have now. I'm the global leader for banking and financial markets in the Institute for Business Value. The IBM Institute for Business Value is our research center that attempts to connect the dots between business and technology. While the technology can inspire business transformation, but definitely facilitates that. But you need to have a balanced and mutual understanding between the two sides of the equation. Yeah. And that is nurtured through not only a series of surveys or data gathering, but an extensive effort, like the one this week, to meet clients, to meet people, startuppers, people in the ecosystem, those that really want to make it happen. And that enables me to see the problem through the lens of the makers, applying my substantiated perspective to understand what all these markets have in common, but also what makes Brazil different than Colombia or France. Yeah. Just to say, the amazing growth of Nubank is due to the capability of those guys who made it, but also some conditions that are peculiar in Brazil that you cannot find somewhere else in Greece.
Exactly.
Right? So all of this, I think, is very relevant, and I try to give it back as I continuously write, publishing literature and research for the IBM, as well as participating to moments like this one, your fabulous podcast, to create another conversation and potentially to unveil another piece of the fintech puzzle.
Fantastic. And it's all about, as you mentioned, like a thought leadership as well. And IBM is recognized as an excellent center for research. There's a lots of good papers that you guys work and develop. And along with that, I think it also boosted your career as an author as well, right? Do you start, like, your first book was during the time previous to joining IBM, or was like about the time when
No, it was in the making, but it was published in 2015 when I was already in IBM. And my literature is part of a longer research process, driven by a couple of considerations that I feel like we can unveil here, and how that I don't know if there are people that haven't read my books, but if there are, they can
like
go
João
and do it.
Bezerra, which is
Exactly.
our mutual friend, he loves your books as well, and a lot of other people, not only for IBM.
Now,
last year, many people came to me saying about your books.
Let me say, first of all, why it is important to go back, not just to read and study. Okay, definitely. So why what you can find in my literature. The issue with fintech innovation is that the banking industry is at the verge of change. There is like changing the way we produce electricity from a carbon plant to a nuclear plant. We need to change the physics theory underneath. So now many bankers and fintech entrepreneurs pretend to make the change without changing the theory, which has been proven to be faulted in the global financial crisis. Yeah. So first of all, I researched through professional engagements and the literature in identifying that positive theory, positive means that can become a business model, that resets the foundations of our action in a way that if you identify value in a more reasonable term, you can digitalize value. Otherwise, you miss the target. And I believe that many miss the target. So that enabled me to start from quantitative finance. Probabilistic scenario optimization is my first book, which is beyond the limit of the capabilities in making analysis about financial markets, in the recognition that they are basically open and cannot be predicted. Then the second book was Fintech Innovation, a bit more fancy, from robo-advisors to goal-based investing and gamification, already identifying the reason why the hybrid model means human and machine had to be the dominant model. Robo-advisors, in fact, did not create outside the model, did not scale. The third is regulation, was on the MiFID II, European regulation, but was highly read worldwide because the MiFID II is like New York. If you can make it there, you make it everywhere. And then the fourth book is the Financial Market Transparency Theory and Principles. Finally, I go to the theory element, which is, if when you read it, is economic theory, but it's theory of open banking, it's theory of platforms. I launched it in Davos during the World Economic Forum 2018. By the way, before, I pre-launched it in Hangzhou, in China, invited by the organizer of an event called the Westlake Cultural Forum, because China at the time was at the beginning of the third year of the opening up. And as they wanted to identify new value perspective, I always discuss the axiology of financial services. They wanted to get that. And Bruno, let me tell you, I don't know how many people will attend this conversation, but I had 45,000 people watching live the streaming of my financial market transparency presentation.
China is another beast.
I was extremely flattered. And you know what the organizer of the event told me? Paolo, usually 100,000 people.
My God.
It was just half of the average. But for me, it was a big number.
Definitely.
And then once I did this, the last one, which sort of brings them all together, like the Lord of the Rings, is the banks and fintech on platform economies, contextual and conscious banking. And the core of the theory that I used as I opened quite a number of BlackRock conferences in 2019, sharing my literature, and I thank them again for that courtesy, is very simple. It is about the truth of the financial services system. This is an industry where few people pretend to know too much about the future, and they know nothing like everybody else because the future is open, cannot be predicted. And the majority of people fear they don't know about the future, but they might know enough to be cautious. So the asymmetry of information that we studied at the university is not properly explained. And Alan Greenspan, the former chairman of the Federal Reserve, who is at the origin of what we see today, the Fed intervention to save the economy, to save the market, he himself, in radical candor, confessed at the Senate committee that was investigating the reasons of the financial crisis in 2008 that he found a flaw in the model. And the model is that, players are rational and markets are efficient. So to be efficient and rational, you need to have full information. If you don't have full information about the future, as somebody has, you cannot be like that. So I wanted to provide a response to that call for help on how we could redefine a theory for financial markets and banking that could be positive in a way that could identify business models that through technology could allow, transform the framework. And these business models are those that in the banking, fintech, and platform economies are explained around the contextual banking platform strategies and the conscious banking platform strategies. So if you see, I made very rich and a variety of different research attempts, which in the end all lead into basically that answer to a question that I've been looking for multiple years, which is the reason I believe is super relevant, and it gets a lot of attention by the public and the CEOs more and more as they get exposed to this. It takes some time, right? Because they get exposed to it. They get the time and read and do, because it is substantiated, more reasonable, and so far it has been proven correct if you look at how banking effectively has or has not been transformed.
Definitely. The cool thing is the way that you put it that in your book about conscious and contextual banking. In my second book, I also talk about contextual banking, but the way you do, you really go deep on that. And I think that there's this matrix that you show. Can you go a little bit deeper on that, and also for us to think and try to translate that into real platform strategies for institutions, what they are missing that maybe you're presenting in your book that could help them navigate this new moment that we have, which also got AI as a component for change, the way the institutions operate. And,
is the product gravity, okay, that has a lot of malice in shaping the way people think, and is a show that many are not willing to abandon. Let me explain this way with a personal example. Mm-hmm. I mentioned the small company that I founded in Germany in 2008, but that is my second entrepreneurial experience. In the 1990s, I helped my brother, because he was the ideator, to build the Amazon of Italy. Oh. Now let that sink a moment. So I built the Amazon of Italy with my brother, and you are much younger than I am, but I'm 55. I remember when Amazon started as a place where you could buy books, right? And then evolved into what we know today. So the idea of my brother is that we could have built a marketplace called InTrade that had a very nice web site where we could sell the best products on earth. And think about it, Bruno, we had at our disposal Italian fashion, Italian food, Italian travel, Italian furniture.
Fantastic.
Now, we were sober enough not to sell Italian soccer, because you know the Brazilian soccer tends to be better according to this, right? And Italian suffer a bit. So that was not part of our portfolio, right? And the good thing is that it was a good experience, but we didn't sell a dime. Oh. We didn't sell anything. Very, very, very few things. And we didn't know why. And we made mistakes here and there, but years after, I listened to an interview with Jeff Bezos on 60 Minutes. It was an old interview of the 1990s when Bezos was only selling books. Yeah. And the journalist asked Jeff Bezos, what's Amazon? Mm-hmm. And Jeff Bezos, with his spirited eyes, I hope I can render them here on camera, he goes, Amazon is not a distribution channel of books on the internet. And so everybody must ask themselves, is a neobank, is a digital bank a distribution channel of financial products on mobile? It's the same question, okay? Mm-hmm. Actually, more complex to be resolved by banks than back then by Jeff Bezos, but it's the same thing. So he explained that, saying, the publishers are sending me letters complaining that I don't understand marketing, and I would not call Jeff Bezos stupid, okay? Ex post rationality, okay? Ex ante. And the reason he says is because I allow the users on Amazon, which is a platform, to post positive and negative reviews. Now, ratings. I know that they can be abused, and I actually thank all of the readers that sincerely posted the amazingly positive reviews of my literature. But when I think about financial services, I really apply a regulatory perspective on everything to make sure that things are not derailing. And he said the publishers wanted me to publish only the positive reviews so that they can sell more, push marketing. And he said, no, they're wrong, because they're not my client. My client is the person on the platform that wants to buy a book, and they cannot take it. They cannot flip the back cover to read the amazing endorsements of other people. They cannot smell the glue, and it did like when I do the same, right? So he goes, they're there, but they will not act. Okay,
Yeah.
So that is the key thing that Jeff Bezos, before anybody else, learned to resolve the motivational problem, which I call the motivational pull and push gap.
Yes.
And then he said, so basically, positive and negative reviews are a transparent way to advise the client of which is the best book to buy, because there is trust of the fact that what that book is what you need. It's good for you.
Yeah.
And if that was not enough, then he concluded saying, only after I use we would say AI today, set analytics, to understand the client and move around and propose something else, right? Basically to invite the client to do more of the platform. And now this is the point and the problem that many fintech and banks misunderstood. Not only the key principle is to advise the client, but the point is that many discuss data-driven banking, the amazing power of data. And they think that if they turbocharge a marketing machine that pushes products to people, they will basically succeed on digital. And apart from very few limited examples, that is not the case. So I always say that data-driven banking is relevant, but it cannot work if it's not preceded by data-enabling client. So how do you allow clients to pull from the digital bank what they need for their financial or professional life? If you don't resolve that, in order to apply that bazooka, you need to most likely end up abusing the fear of missing out by the bitcoins, and that is not appropriate, right? And just to conclude, as I mentioned, the event in Hangzhou that I met back then with the folks working at Alipay and Alibaba, as the office is around there. And e-commerce and banking is very different. The reason is because now people know basically what to pull from the platform, okay?
Yes.
In banking, that's not the case. Remember, this is the thing. The phone in your pocket is a pull technology of the demand. People don't go on Amazon to see what happens. They want to buy one of my books, and please do so. And then Amazon goes, Paolo Sironi, IBM sell mainframe. Please do buy. Okay? But most of the revenues that matter going forward out of commoditized markets are operated as a push mechanism. They're offered to people. So you can make it happen in fintech and digital banking if you understand how to put an offer economy onto demand-driven technology. So the examples in e-commerce that I also provide needs to be taken with great care, carefully. So when I spoke to the friends of Alipay and asked them about the way the AI works on the Alibaba platform, they said that effectively in e-commerce, 364 days of the year, their AI algorithms have a certain capability to interact with the client. But there's one day of the year when they become way more powerful in terms of pushing, which is
The
11/11,
Yes.
the Black Friday, because you go there for the discount. The rest of the year, you go there because you want to buy that book, right, or that pair of shoes. So you can be moved around and helped, but there's more resistance. So they see the difference in the psychology of the client according to the initial motivation. Now, you cannot expand that directly to banking because now we're used to do that. Now we are capable of pulling from Amazon, from Alibaba, things that we look for, but still we are not capable of pulling financial services out of that with the same confidence. And there are reasons for that. And let me tell you, it's hard to believe that can be happening at the same level as long as something is done. So my role is to not tell you what the future looks like, but to identify which are the preconditions upon which a certain future can be realized so that either you see it happening or not, or you make the right investment to make it happen.
Exactly. And the cool thing that you mentioned is the changing perspective when you're like a tech fin player, just like the players you mentioned in China. I think they can also see this business and this game through another angle, right?
Well, I can give you this example of China because, which is a public example because it was published in Chinese with a Chinese bank. What is the definition of contextual banking that I inherit from our common friend Brett King? It is the opportunity to eliminate a friction, typically in the ecosystem, that makes banking contextualized, embedded, invisible, to generate new value. Now, Bruno, I'm speaking to you like a central banker. Don't know if it makes me good or bad. That means, however, that every word matters. So I said that generates new value. It means that the value is not in the transactions that commoditize. Yeah. It's somewhere else generated at the level of the platform they play. And that is also, and already the case when you think about Amazon, because when you think about Amazon, although 80% of the revenues are generated by the marketplace, less than 50% of the operating margin is done by the marketplace. So Amazon is a cloud company, it's AWS, right? Exactly. With Amazon. And Amazon tried to stabilize the interplay with Amazon Prime. So you get fees that stabilize your perspective, while the transactions are commoditizing more and more so, and the margin is getting down because the cost you have to put on top, right, of your logistics is ever increasing, right? So you get into the situation. But what is the definition of value that is different for a bank? I was having this conversation with the Chinese banking community in 2019 as I went to Shanghai when IBM both opened our new Shanghai office, and I think we opened 2 more since then. And I was discussing this perspective that talked about the value versus the volume, right? The transaction and the value. And if you don't identify value correctly, based on a theory we mentioned before that is more reasonable, you cannot digitalize it. And the top exec of one of these banks, actually SPDB, okay, because they will publish together. I said, that's interesting. So we had to talk with the chairman, and that led into a common effort to write a paper that they called panoramic banking. Don't tell me what it is in Chinese, okay, which actually can translate like holistic banking, but panoramic is what they preferred, which basically is about how you build the platforms of the platforms. Now, that bank already created an ecosystem. And what it said is that we thought for a while that we could compete with WeChat and Amazon on volume. Yes. Forget it. You just can't. Yeah. So we misconfigured our ecosystem platform definition. Instead, you say that we need to define value differently. So that's where we need to compete. Now, that led to the creation of this paper that we published. It was published only in Chinese, and we launched during the Fintech Inclusion Conference of Alipay. I participated with the chairman of the bank online because the pandemic struck already, so we couldn't travel. And what you find inside there is exactly the framework that I built for my banks and fintech platform economies, which is the banking reinvention quadrant. Tries to basically resystematize all of these concepts, explaining and leading into a discussion about investment towards contextual banking and investment towards conscious banking, where the definition of value is what matters. Value that you create through time, but if you're not deliberate about defining that, you will now get to the end so you can create an ecosystem platform. I'm seeing some in the market, but that they're not sustainable because they don't generate the value that they're supposed to generate.
Nice. And how do you see that this whole concept influence in the competitive space that we have right now? Because in a lot of the events that I participate in, especially here in Brazil, there's a lot of talk around a primary institution of a client. Now we have a broader set of players. We have from retailers that are moving into this field, e-commerce players that are moving into that, and also the banking players that are also putting non-financial offerings into their ecosystem and trying to create all that. And on top of that, we have all these conversations on new channels like WhatsApp, and some players exploring WhatsApp as a point of contact as well. And this whole AI first discussion. So how do you see like the competitive scenario when you have all those different variables and there's need for reinvent the banking model and the way that clients are interacting with financial institutions, or not purely financial institutions?
You want to know who will lead the pack in terms of the next wave of innovation?
Who?
Because your question is powerful and complex at the same time. So I can only focus, I have an answer for all, but I can only focus on a little cut, given the time that we can dedicate in this conversation. And I have to say that if you go back and read our research in 2003, which is on embedded finance, that is enriched by Diversify Makers 2023, which is conversations with execs that are active in the embedded finance framework and world. They are pretty deliberate in discussing basically what is the definition of value, and the fact that you're not successful with open banking, open finance at the level of the transactions, because what you sell is not the API connection, is the use case that goes beyond that and is more engaging about what happens with the client in their own personal journeys. So is out of the individual APIs, a collection of all of them, right? And like you get the BBVA, for example, perspective, one of the first building a marketplace for APIs, and that's basically what Carmela is saying in that conversation is pretty clear. But what I think is happening here is that while we see the investment in technology, we are opening the framework more and more, and we are definitely adding more and more instability. Let me use the word instability in a non-judgmental way. So let me say it this way. There was a time where technology was purely on-prem here in this room. And then we started working on cloud, and the difference is that the cloud broadens the vulnerability surface, and also is not just a computing capability, is a way of working. When you go cloud native, you change the way you work, not necessarily where you position your workloads. That in the end requires building stronger and more differentiated competencies to do all of that. And that's what banks experience through the years, that they might have simplified the economic model around cloud, and they had to go back and add people and stuff, which added cost, which limited the capability of extract value from cloud, because there were some preconditions in terms of the way you work and the simplicity of the process that were sort of left like maybe for tomorrow set of thinking that impacted the capability to generate value. Now, with AI is happening something similar. We move from analytics, which are very deterministic, if and then. Technology has always been asked to do these things, right? Build a database, move people, things from A to B, and maybe to C, and that's it. And now it's machine learning, which starts to get a little bit more complicated. So people had to invest into robustness, transparency, explicability solutions for that. And at the time where we thought, okay, now maybe grab the issue and how to deal with that, generative AI comes to the fore, which is, again, more unstable in the sense that is probabilistic, highly probabilistic. And beyond that is agentic AI that we put this on steroid. So all of this needs to be considered because it requires a different way of working with technology compared to how we've been used to work with technology for the last, let's say, at least 50 years since the computer revolution started in the 1970s, 1980s. So the IT departments of banks now are tasked to develop analytics which are not anymore the response to a business requirement and then you build a database, but have embedded a lot of, I use again the word instability, could be like probabilistic perspectives.
Yes.
In the past, those competencies were confined to the average hours of trading floors and the risk management that build like systems and processes around themselves. It took them most 20 years, and also a lot of mistakes that were made, right? And we still feel the pain about that. But they were happening there. So now this happens in the IT department. So if you ask me which is the institution that is poised to make the next step forward, the distancing from the others, leveraging the opportunity that AI presents to business and IT people, I say is that bank or that fintech that understand how to do the risk management of AI and with AI, because they will be capable of managing this technology with more comfort compared to others. So on the one side, the departments that allocated this data scientists and competencies to deal with technology needs to learn what is the risk management perspective for them to move forward. And at the other side, the risk managers needs to look at technology in a different way because they tend to be more distant from the problem, like they operate ex ante with rules, things happen, they're exposed to the verification. But on digital, things need to happen instantaneously. So how can you do that while remaining independent? That requires a redefinition of the role, the competencies and interaction of both players that needs to be baked into a governance platform, a real technology underneath that allows the development, testing, and promotion production while feeding transparently a perspective of the risk taken. Why does this really matter? We've been in the IBM Institute for Business Value in serving 3,000 execs worldwide beginning of this year, of which 300 of financial institutions, asking about the risk of technology. And I would say for the first time, 67% of CEOs of financial services said we must take more risks if you want to get the benefit of automation with AI and maintaining or leading the competitive edge with AI, which for CEOs of financial services is peculiar because typically they need to be, by definition, prudent.
Exactly.
Right?
Yeah.
So, but this is what is happening today. So that positions the risk management perspective front and center as the real turnkey that allows to start scaling AI enterprise-wide, which is the reason why I'm more than pleased and happy and flattered of the opportunity ahead to launch this the risk management of AI and with the AI paper that everybody can download from the ibm.com/IBV pages.
This very one here.
This very one here, I think this smaller printout, it should be bigger. And being here, with the friends and new talking to the risk manager because it is the conversation that needs to be had in every bank, in every fintech, that will lead them ahead and out of the pack.
And that might be the main bottleneck for why things aren't accelerating in the institutions as it would be accelerated, because I think the pace of change is very, very fast. And the cool thing, as you also said in this paper, which is every banker must now be an AI risk manager, right?
Yes. So Bruno, in the 1990s, where I was a risk manager, the CEOs of banks started saying that every banker is a risk manager. Yeah. Risk being the business of a bank. Remember, the business bank is to manage the risks and the risk of the clients, right? For the clients. It's not just transactions of products, right? And the balance between the two is very complicated. And now I'm saying every banker must be an AI risk manager. Every insurer must be an AI risk manager if they want to find their way into these exponential technologies that allows them to box out while remaining comfortable, right? But it is a reconceptualization on a lot of things, because though you can say the risks are no different, just like with different intensities, I actually would think that there are some new risks that technology did not have inside compared to the past. The way you relate to those risks and the way you mitigate those risks is different, and organizationally speaking is different. So again, this is where I do believe when I talk to clients, when I hear them talking with more deliberate language around the risk management perspective, then I do believe these are the guys that can lead the pack.
And the true challenge is trying to redefine that internally. And one of the things that also getting on this topic, you've been mentioning in your keynotes and writings, you propose that we revisit the biological micro-foundations of finance, right? If you were to reinvent it. So can you explain a little bit more about what do you mean with that specifically, and how can we align that incentives with real human value instead of legacy revenue logic?
So Bruno, that's actually, because again to what I said, that mobile technology is a technology of the demand, while most of the revenues operate on an offer economy, because the real structure of financial markets, that means financial services, is uncertainty.
Exactly.
Now, risk management, if you like, add another concept, is just like a way of cleaning the table because whatever you measure is not set in stone. Is what you don't measure that makes sense. So as a head of market and counterparty credit risk, I had weekly meetings with the CEO and the head of trading and the chief traders. And what I was doing was not to go into the meeting and say, hey, this is my value at risk, my expected shortfall, whatever. I used to say, hey, this is my numbers and they're wrong. Because you know what? What will make you very rich or very poor is what we cannot measure that will materialize. And it's that conversation that augments the consciousness of the system, okay, in order to position our capability to make risk-taking. And that's very different from a transaction where we push products. It's about the understanding of what we're doing, knowing that in any case, we are never in full control when we deal with financial services opportunities. So at the heart of this, therefore, is the unknown that cannot be measured, which is uncertainty. That is not exogenous, it is endogenous into the system. And therefore, it is addressing uncertainty in financial services that dictates how you generate the value for clients. I'll just give you an example, the difference between this and Amazon. If you buy a tie on Amazon, and maybe like this one, and then your wife says, Paolo, blue does not suit you, yellow is your color. You know what? You can return it, right, and get the money back. And now instantly, now don't ask me why I did not return this one. Okay? But if you buy an investment fund or an ETF, and then the market shifts and you lose money, you cannot return it.
Sure.
So the amount of uncertainty built inside the decision making is completely different.
Exactly.
So with AI, it goes the same. I'm talking to banks that have been using AI for a payment in conversational banking, and they tell me when we add the capability for people to move money with voice, talking to an agent, we see that a lot of clients walk out. And they were asking, well, I said, it's simple. If AI adds uncertainty, the client push back.
Wow.
If the AI eliminates uncertainty, the client is drawn in, right? So one of the key design thinking principles, or the first principles that Brett would put it to me, is how much uncertainty are you adding or subtracting with exponential technologies in the way you deal with a client, or you allow the client by themselves to deal with technology? So that is the key criteria. So uncertainty, being the structural reality, is biologically rooted in the way we think. It's just that we are not necessarily conscious about that. So, yet again, the behavioral scientists pretended that finance is like financial people told them, or research managers, is a mathematical problem. And they say people are not rational, you nudge them, they go back to rationality. But I'm telling you, it's wrong. And the reason is because you can be rational only if you have 100% knowledge about the future, so the data is complete. Data, even big data, will never be complete. So that is a faulty perspective. So being rational means that you accept that you cannot measure everything. So you accept that you need to deal with uncertainty. So what they call a bias, I say sometimes, is a warning. And just by changing the way we look at this, allows us to understand differently how we can serve the client in their capability to deal with uncertainty. Like anything they're doing in financial services, this is the prime element and the most important element to be considered. So as this is, in the reality, is beyond psychology, is biological micro-foundations. Okay, that's why I defined it that way. And so it goes back into the theory and principles of financial market transparency that is embedded into the banking fintech and platform economies. And just for the people in the audience which are not versed with financial services in terms of business, but maybe are more on the technology side, I can give you the same parallel. You know chaos engineering.
Yeah.
So there's companies like Netflix that pioneer chaos engineering. What it means that you accept as an engineer that your system is not stable, so that the servers can crash. Now, resilience is important, but resilience is not a matter of ring fencing into stability, like where we were on-prem, for example. Now you're on cloud, it's different. So what they do is they created some monkey service. So there are processes that in production kill the servers, shutting them down, and they force the engineers to remember that uncertainty is part of the system. It's never eliminated. So they have to sweat their brain in order to make sure that the system does not collapse, okay, and adaptively moves the things around, to stay afloat. And so even in technology, understanding the role of uncertainty is important. And if you now think about agentic AI, you bring that to the limit where, as we discuss in our IBM research, you have way more dynamics operating at the level of technology. To me, you need to be capable of understanding what happens if one agent goes down and the rest goes up. So it is, again, to me, without a strong causal engineering perspective, it would be very difficult to control these elements. So there are preconditions, which are, call them philosophical preconditions. Some say that I'm a philosopher, but they're really practical.
Exactly.
It's just that the way you explain them requires an element of abstraction that then leads into practicality. So spend time not just to read, which is already quite something, spend time to study. And spend time to study more reasonable micro-foundations of financial markets, which then lead into decisions with technology and with business that make a lot more sense, and that will differentiate to create sustained value for the client and for the institution.
Definitely. And we're going to see more and more changes in the behavior of the clients going forward, especially the ones that are going to be into the whole, interfaces with AI, with generative AI, even with agentic AI. I think we have a whole new word. And if you project like 20 years,
Bruno, something also that is happening and is kind of funny. I find it funny, but if you consider banking as a pure transactional element, this is what is happening. And I was told this by a banker in one of the most, in Northern Europe. Okay, so the Nordics have typically a very high level of digital penetration and zero cash. So because in 2008, when the crisis started, the banks had to cut costs, okay, because they were unsustainable. And luckily for them, that was when the iPhone was invented. People were not just shifting to the website on the internet revolution, but also they were onboarding on the mobile, the smartphone. So for banks to build digital apps and digital web internet banking and move clients there was a no-brainer. So that was good, right? They could do. But that had consequences because they lost the contact with the client to position in a transactional world more products to lead profitability.
Yeah.
So to the point that now there are some banks that call clients to get them back to the branch, right? Because on digital you cannot generate the same revenue that you do in the branch. So also this is important. You cannot just abstract yourself from the biological micro foundations and pretend that what happens in a human conversations happens on a digital app. It's very difficult, the way the people buy the products or the type of products they can buy or cannot buy. So then also banks have learned how to use AI, machine learning in particular, right? So sort of to go around the client and to put notifications on the app. So it took them some years. Maybe the fintech were faster, but thanks to recreate a framework where on the basics or their product catalog, because they cannot necessarily do that for investment management or more complex insurance, but basic means credit cards, right, that's small short-term loans. So they learned how to put notifications around the information there for the client to be more timely, more personalized, an element of contextualization within banking instead of being outside banking. Okay, so that's why I use contextual banking more than embedded finance in my literature, because it's a bit more like a broader, because it can be applied on both sides of the equation. But then they say, what happens is now that we are shifting the clients from accessing the mobile app into getting into a conversation with a generative AI agent.
Exactly.
And what happens is that maybe the client moves there, but we lose the capability to send the notifications and to sell products. So if they go, we're losing the client again because the mobile app becomes a new branch.
Exactly.
That's pretty interesting now. And that happens because the definition of value is around the transaction or somewhere else, right? So there could be broader discussion, but it's funny to see what happens here, right?
And new challenges there.
And it's important for all to understand, because in the end, you're building a business, right? So rightly so and hopefully so, first and foremost, the client must receive value. In a regulatory perspective, it's value for money, okay? But then you also need to get the money, right, in order to keep on innovating, paying the salaries and stuff. So it's a complex balance and needs to be found. But the balance on digital will be found outside the definition of value as we are used to, as I said before. That's why, again, we need new theory, we need clarification, and we need a new understanding on how we use the technology to make that happen.
Fantastic. You're just mentioning the change from branches to mobile, and that's the very subject of our collaboration with Brad King that's going to be released soon.
Yes, Bruno is
tomorrow.
so flattering that together with Brad, me, you, and other friends like Jim, Richard, Effie, we've been crafting this new book, the second edition, talking about the fate of branches in the market, different opinions baked together, right, and differences around the world. And hopefully that will be released very soon, and I'm sure that everybody will want to read it.
Fantastic. So, Paolo, another thing I wanted to ask you, on top of your travels all over the world that you make to meet clients and get in touch with different local realities when you talk about banking and the challenges of banking, and we have various levels of evolution of local environments as well. But I would like to ask you, what are the main concerns from financial leaders that you've been hearing from them in most of the meetings that you do? Is there a single point now, apart from, and maybe I think something related to AI might pop up, but what do you think is more related to what kind of concern, the discussions that you guys have with these players and leaders in the financial sector all over the world?
Okay,
there could be a common aspect on that, if there is any.
Well, there's something that I think that many have not yet fully understood, which goes around AI again, because clearly there is an effort industry-wide to understand how you can manage it, like bias, ethics, drift, so on and so forth.
Yeah.
But imagine we're in a world where we build the platform with governance baked in that allows you to control those elements. There's still something else which is happening. There is how do you bake the business strategy? So the intentionality inside the AI algorithm.
Yeah.
And that is super important because in the end, that is the real turn of the key. I can go, which is still consistent with the risk management perspective I mentioned before, because within the risk management you have an understanding of basically what you are doing in terms of promoting your algorithms or promoting your business strategy, okay, out there in front of the clients. What does it mean that? It means that I was talking to the CEO of a very large institution for AI, and that person asked me, how can I convince the business people to embrace AI, right? How can I change the culture? So my counter question said, okay, so how could you explain to them that you can embed business strategy inside your algorithms? And the person goes, what do you mean? Right? So we're not there. So let me give you this example. So think in a simplified term, okay, that you're dealing with having people to buy financial products. And now we are in a world, in a maybe not distant future, where agentic AI will take care of the whole conversation with the client. Now, imagine that there's a new pope, and the new pope is, lived in Peru. And they're like, okay, there could be a narrative for people who are sensitive to the theme, right? So let's figure out, what's in Peru and, try to sell those products to the client. So what happens now is that the head of the P&L, the business person, will have a call with all the bankers in the branches or the advisor network. We discuss the topic. People are not perfect, but they will adjust. They understand that that's a good conversation with clients. They have it. If you live in a world where everything is fully automated and managed by agentic AI, that business person will have to talk to a programmer and explain the opportunity. The programmer will have to understand the strategy, code the strategy. Then the programmer will have to test the strategy. Then the programmer will have to promote the strategy. By the time, most likely, there's a new pope.
Yeah.
Okay. So And not only that, but the moment you build intentionality inside your algorithm, in essence, you have to drift it consciously, right? So you need to ask yourself, is my business model consistent in an hyper transparent world? Because I want AI to be hyper transparent, but at the same time, the intentionality built inside the system to be conforming to an hyper transparent world. And that's where I think like they will stop like looking at the problem and they're like, oh my God, what is this? But luckily so, I have a solution for that, which is baked in my literature because it's about how do you promote in positive theory business models that are conforming to a hyper-transparent world that AI brings to the surface. An interesting thing of AI is that while the technology is in itself a bit opaque, because we said it's probabilistic or unstable, is much harder than in the past. At the same time, it forces to be hyper-transparent to deal with that complexity. Now, those institutions or fintech, and some are like thinking around that, they will be capable of being transparent in the way they define the business model. Will also be capable of learning not only how to manage AI, but how to bake business strategy inside AI, and therefore we get the full capability to go full swing with the utilization of technology. But still, apart from being baked on and based on what I've been researching on and publishing, it is a risk management perspective because it is, again, rooted into the real tender, what motivates clients to buy financial services, and where is the remuneration of the value for money that you need to get out of that. That is the real transformation that fintech innovation can bring on the table.
Definitely. And I think about the word where we have like trusted agents as well to help us on that, and that might, shop around different offerings from different players. And there is a hard component on balancing transparency and this AI agent that is going to try to get the best for me, but most of the time is going to be hard for the institutions.
Facing uncertainty,
Exactly.
would that add uncertainty to your money or eliminate uncertainty to dealing with your money? Remember, when you add uncertainty, the client will be like, when you eliminate uncertainty, the client will want to embrace it.
Yeah.
And we actually released a recent paper, is actually the consulting colleagues in Australia, about agentic AI that is very nice. I invite everybody to read, which is about the risk and opportunities of AI. So together with the banking community down there, they identified 15 risk elements and corresponding mitigating actions that you need to put in place to make sure that the moment you move towards agentic AI, you know what you're doing, because the point is you know what you're doing. So that's a very nice paper by the colleagues, a bit techy in essence, but it systematizes the framework to explain which are the things that needs to be considered to allow implementing agentic AI in a way that it can be, if you like, managed, right? And you can relate to that in a proper way. Without that, you cannot do it. So the point here is you can get dissatisfied with the usage of technology if you don't make the consistent right effort to use technology.
Yes, yeah.
So that's why this risk management of AI with AI is really the turnkey to make sure that you can do the right thing so that the result is most likely good or better compared to the previous alternative.
Fantastic. And I'll put in the link in the description of this episode, not only the download for this new material that you guys produced, but also this agentic AI report, which I think it would be very helpful for the audience. So Paolo, we are reaching towards the end of the episode. Was great. I think when it's good like this, times flies, and then we get to the end.
Too.
Yeah, exactly.
I'm always flying somehow.
Exactly. But I would like to ask you as a final thought here, in the face of all the rapid changes that we just mentioned, they're impacting the market right now. What advice would you give to financial institutions leaders that might help them prepare for what is coming and deal with the challenges ahead? I think you kind of responded that in different pieces of our conversations, but trying to summarize that and give an advice that you would give to clients, but to
it's
leaders.
Another good story takes me 3 minutes. Okay? Since a few years, in the IBM Institute for Business Value, we've been researching on which are the next skills and talents, okay, that are needed to move forward with the transformation that technology brings to the business forefront. And I was making this presentation of this data point for the first time in an event for talented transformation organized by a bank. They invited 500 engineers, so the core, because they have thousands of, right, in a room for one day in an auditorium to discuss all of this and asked me if I could open that day with a keynote. And that data point shows that in 2016, asked around the 12 categories, which were the most important skills, proficiency in STEM was the number one. Now, I don't know, Bruno, if you are an engineer, an economist, what is your background?
Business administration.
Business administration, so it's like engineers and not creative. So creativity was fairly low, okay? Now, I said economics, I should not be creative. I think I'm creative, so believe you are creative too, okay? So no anxiety here. And then in the middle, there were other things like time management, teamwork ability, prioritization. So in 2023, the end of 2023, we remade that survey across 3,000 execs. And do you know where proficiency in STEM stood in 2023 before Agentic AI started? Was it number 1, 2, 3, 4, 5, or 12?
3.
Number 3.
Oh, yeah.
Okay, let me tell you, there was number 12 at the bottom.
12? Oh my God.
And you know what goes up? Creativity, right? No, there was sort of like number 8. So we went to the number 1 is prioritization, time management, and workability. Now, you could hear the brouhaha of 500 engineers gathering to discuss if they use Python, AWK, more than C++, or another programming language. And I'm telling them, like, but it's a flux, not a picture. So the CIO of the bank comes on stage and says, he scolded me. He says, Paolo, you've been too much too provocative, okay? I said, okay. But then we spend the whole day together, and at the end of the day, it's a true story, there's the exec committee, the 500 engineers, the core of the engineering platform, and the CIO goes, today I've learned something important. I've learned that our industry is too complex. I've learned that our bank is too complex. We don't know how to manage time. We don't know how to prioritize because there's something new. And now think about with Agentic AI and generative AI, things happen. The life cycle of technology became so fast that every 6 months, there's something new that really have to consider as priority and you haven't resolved at the past, right? So he goes, it's crazy. And then he goes, we try to be agile everywhere. We are agile here, we are agile there, and we are agile nowhere, right? Because we had the platform to share that element of value. It was a nice, funny sentence. So he goes, if we do not learn how to simplify our business and technology, we can add as much as talent and fancy new tech, we will not move the needle of financial performance, which is what constrains quite a number of financial institutions worldwide. And to me, that's important because technology is powerful, and when it is not perfect, it will improve over time. There's no doubt about that, right? But there's a precondition upon which technology can effectively unlock the potentials in a fruitful way. And those preconditions are human decisions that needs to be made about how do we simplify the business model that is reflected in a simplification of the framework, even before we basically decide on that journey for transformation. Instead, we always try to change the wheel while driving the car. And it's not easy. You get the point, right? Nobody wants to stop a moment, right?
Exactly.
But, maybe that's not possible, no, but in the end, that's an important precondition. So that's my point here. Really have a thoughtful discussion, business and technology, about how much can you simplify of your business model that facilitates the capability to plug in new technology like AI in a fruitful way, in a timely manner, that help you to generate more value. Without that one, it's very hard to believe that they can make it happen.
Amazing. Great story, Paolo. And well, as I mentioned, we are reaching the end here. I'm going to open the space for you to do your final remarks. It could be like where to find you any institutional message or any message you want to give to our audience, so please feel free to do that. Looking at me or looking at the camera?
I really travel a lot for the good and for the bad. It's actually an effort, it's an investment, right? And that's the reason why I'm very happy to be here in Brazil, because I have so many friends in institutions, yourself. So it's such a pleasure when we make this investment, also to meet people that are so open and so willing to make a step of the journey together. In the end, I am also very active on social media, but I tell you, social media is a complex space. A is very noisy, but B, it wants to, distill everything down into the shorter potential version of the message that does not allow many of us to see the full picture, right? Now, again, I don't know what the future looks like. I'm not a futurist, and I want to be. My role is to identify the conditions upon which a certain future can be realized, so that when you understand those, you see it if it is happening, or you make the right investment to make sure that you have a higher chance for that to happen. But that requires not just to read, but also to study. I made this effort to produce research in the IBM Institute for Business Value, as well as my literature that is a friction that is needed. That means dedicating time to do that. So I hope that if your amazing audience haven't done that yet, you will get a chance at least to start from the banks and fintech on platform economies, contextual and conscious banking, because it is, I believe, the most comprehensive and reasonably grounded perspective you can have on how to redefine value in financial services so that effectively you can digitalize value.
Fantastic. And a great piece of work and deep research as well. So Paolo, again, thank you for being here, and thank you for coming to the podcast and also to Brazil. I hope you come here more times, more often as well.
I will be back soon.
And you, hope you like it, the episode. Don't forget to subscribe and like this episode, and also to share that with someone that really wants and needs to hear this kind of message that was delivered here in the podcast. See you till next time.